how much you spend. Yeah, so how much you earn has almost nothing to do with how you can build wealth. And I share that with you. I'll tell you a little story. When I was working for KPMG, we had a partner. He was one of the senior partners in the regional office, and he earns £25,000 a month. And you'd be thinking, £25,000? That's not too bad. Yeah, but guess what? He's always in need of money. He's living from paycheck to paycheck because he has no emergency funds. He has no savings at all. So even though you can earn so much money, it has no implications on your ability to create wealth and to make millions. Yeah, so all of us can do this. It doesn't matter how rich we are, how much we earn. We certainly have the propensity to save, and we should do that. Maybe also this as an example for you. These are extracts from my finance class. What we have is a diagram or graph here that has on the x-axis we have standard deviation. A standard deviation is a classic measure of volatility. So we look at volatility against returns here, so a risk-return trade-off. And of course, common sense says lower the risk, lower the returns. Sure enough, here we have treasury bills. This is 1926 through to 2005. Yeah, so treasury bills offer you the lowest return, but of course they have the lowest risk. Because why? The US government issues the treasury bills. They are almost seen to be default-free. Do you know why government instruments are seen to be default-free? You see right now, even in Greece, yeah, you have everyone else helping you. But more importantly, in the US, you have, as a government, you have control over public finances, which is taxation. So you can tax a little bit more, and you have the other control is the ability to print money. And that's why we always say or always associate government instruments as almost default-free. So low risk, low return. On the other hand, let's say we're really gung-ho and we are bullish and we want to take on risk. So what we do is buy a whole bunch of small stocks. Small stocks, well, why are small stocks seem to be higher risk? Because they're more likely to collapse. You don't know what's happening, what's going to happen to them. There's a lot more instability, and that's why the higher the risk, the higher the return. And of course, we have on this trade-off in different classes of instruments. Yeah, so we have bonds. So bonds are a little higher risk than bills, than world stocks. S&P 500, which is an index, is an index of 500 companies listed on the New York Stock Exchange. So it's like an average, yeah, of all the 500 stocks. And then you have mid-cap, which is medium-sized stocks, because S&P 500 usually has the biggest companies, biggest 500 companies that are on the stock exchange, and then of course small stocks at the very extreme. You might be wondering what's the scatter plots here, all these little dots here. So if you have the time and the patience, maybe you're counting right now, there should be 500 dots. Okay, but don't count. Let me show you some things. Here we have different kinds of stocks here. So what we do is we take 500 stocks that's listed on the New York Stock Exchange. We rank them according to size. So we have the first 50, which is the biggest stocks, and then we have 51 to 500, and then of course we have the smallest stocks, 400 to 500. And what you notice is all the triangles are around here, they're kind of central around here. Why? Because the bigger the company, the lower the risk, the lower the return. So big companies tend to have lower risk, yeah, and small companies, right here, tend to have higher risk and higher returns. So these are individual stocks, and what we then do is we create a portfolio, put them all together, and buy the entire index, and that's what we mean by the S&P 500. Because they do not correlate positively with each other, there is some benefit in putting them in a portfolio, 500 different companies, and you look at what's happened. You have actually reduced the risk considerably because this spot here is far lower. Yeah, the risk is far lower than any of these dots over here. And what you also realize is that your returns are nowhere as high as this, but not any lower than that. So you're getting a very average return for a much lower level of risk. And that's what diversification does for you. All right, but there is something else, the greater truth here, resulting from the financial crisis. And this is what I tell my students all the time. Not only do you diversify in terms of the stocks that you buy, what you can do is to diversify across products. So don't just buy all the stocks. Consider bonds, consider real estate, consider commodities, consider forex. So have a range of different instruments because you reduce the correlations between, you improve the negative correlations, because they are less positively correlated. Fund managers have superior information, and hence investing in a fund will bring you superior returns. True or false? Well, looking at how I'm gearing this whole thing, it's probably false, because I think you can be your fund manager. So it's probably false. And the question is why? Let me show you. It's false because what we have learned from the financial crisis, and studies have shown this as well, performance of fund managers are no better than all of us. In fact, most funds are down, just as you are down if you individually invest in the securities. And what is worse is this. Fund managers still earn the management fees from you. Every month you have to pay, or every year you have to pay, and you can't say no because you're losing money. Yeah, so they still make money when you're losing money. Very nice. Next one is actively managed funds have not consistently performed better than passive funds. Do you know what's the difference between active and passive? Okay, active is where you have a dedicated team of fund managers. They are the ones who are devoted. They will create the investment strategy. They will execute. They will create the whole portfolio. Passive, on the other hand, is forget about the fund manager. What you have is a computer system, and the computer system with its algorithm will actually create the portfolio for you. So you mimic something. Yeah? So you mimic an index. You copy an index. You copy usually they are indices. Yeah. So it's whether a general index or a very sector-specific, country-specific index. And what you realize is that actively managed funds, so with all the money you pay your fund managers, they have not consistently performed better than a passively managed fund. And this is absolutely true. One of the lessons that we can learn from this whole event, whole saga, the first lesson is, and that's common sense, we ask, what is your track record, Mr. Fund Manager? So, the two questions that you should ask when you entrust your money. So when you go meet with your banker and he comes up with all these different proposals, the first thing you ask him is, what's the track record of these funds? Yeah, so what I want to know is this. What are your returns, or how much money did a particular fund manager or fund make over a period of time? Yeah, so I want to know what is your record. With this idea that, well, the reason why I want to know your historical record is because I believe that maybe history will tell me something about the future. Yeah, so it gives me some idea of what projections may be. If you're consistently good, then probably you're going to be likely to be that good. That's what you're thinking in your mind. Yeah, and there are many websites that actually offer a lot of information. So if you are actually an American investor, you have lots of information. Morningstar is one of the most classic websites. It's like the mutual fund website that everyone quotes, because what it does is it provides a lot of information on any fund that you can think of, and it tracks it over periods of time. Yeah, so you can see, okay, who are the fund managers? What are their returns? So what should you be looking at? So they give you the track record, and really what you should be interested in is a 3-year, 5-year, 10-year number. Forget about 1-year returns. 1-year returns is just sporadic. Yeah, it could be skill. It could be luck rather than skill. And what you want is consistency in performance. Yeah, so funds are a long-term investment. So what you want is a portfolio that will show an ability to make money over periods of time, long periods of time. Yeah, and the next one is, sure, you can find the returns. Yeah, the 3-year performance, 5-year performance. What you're also very concerned is how does it rate relative to other funds. Yeah, so if on its own, it can show phenomenal returns. But if every other fund in its class actually outperformed it, then this is not very good. So in absolute numbers, it doesn't mean anything. So what you want is to see the relative numbers, and that's what you're interested in.